Hello friends. Now that we have studied about a few basic terms with respect to accountancy such as debtor, creditor, asset, liability, and also we have been introduced with the concept of double entry accounting system and accounting equations. In this video, we are going to discuss as to why do we do this accounting, what are the limitations, objectives, and various subfields of accounting. Let us begin with the objectives of accounting. Suppose I have started a business with capital of 20,000 rupees. I had brought this 20,000 in the form of cash. Then say I have purchased goods worth rupees 10,000 rupees with cash. So these are two transactions that I have done so far with respect to my business. So what do we do in accounting? We will record these transactions in the form of journals. So the accounting entry will be cash account debit 20,000 rupees to capital account 20,000. For the second entry will be purchase account debit 10,000 to cash account debit 10,000. Now, these are known as journal entries. You might not be able to understand it so much right now, but in the chapter just after this, we are going to study in detail as to what is a journal entry. It is the basis of accountancy. From your 11th standard till the time you do accounting, you are going to do it with the help of journal entries. So this is the first step or the first objective of accounting, that is to record all transactions. The next is the ascertainment of results. Now suppose we have spent rent 5,000 rupees, purchases 10,000, insurance expense 15,000. These are my total expense for the year and I have done a sales of say 40,000. So my profit for the year will be 10,000. This is a function of accounting. Once we have recorded all the transactions, then for a particular accounting period, we derive what was the profit or the loss of the business. As we have studied before, if the expenses are more than revenue, then we have a loss, and if the revenue is more than the expenses, we have a profit. The next is the ascertainment of financial position. In our previous videos, we had studied what is an asset and what is a liability. An asset is the property of the enterprise in which the company owns an interest, and a liability is an obligation to a third party, a promise to pay in the future. So suppose during the year we have made certain purchases because of which at the end of the year we have stock worth rupees 20,000, we have cash 10,000, say we have furniture of 50,000. So this is my total asset. Now, because of these assets, I have a liability, say creditors of 50,000, 40,000, and capital of 40,000. So, my total liability will be 80,000 rupees. So, this is a balance sheet that we prepare in accounting. This balance sheet tells us the position of our assets and liabilities, what is the total value of assets that the company owns, and what are the different types of asset, that is cash, stock, furniture, etc. Plus, how this asset is financed, that is, how much of it is financed by the owner, that is the capital portion, and how much do we have to pay to a third party for acquiring these assets, which is the liability. The last objective that we are going to discuss is communicating information to the various users with the help of financial reports. At the end of the accounting year, by way of law, every company, firm, or every such business enterprise has to publish an audit report. The balance sheet and the PL account forms part of this report. Therefore, it communicates to the various users of the financial statement, such as the owners, suppliers, customers, investors, etc. What is the position of assets and liabilities, and how much profit or loss has the company made during the year. So, we have discussed four objectives of accounting. First is the recording of transactions in the form of journal, ledger, etc. Next, the ascertainment of the profit or loss made during an accounting period. Next is the ascertainment of financial position, that is, the status of assets and liabilities. And last, communicating the information to the various users, such as suppliers, investors, customers, etc. Next, the functions of accounting. It is a step-by-step process. First of all, in our first video, we had studied that all transactions are recorded in the books of accounts, whereas all events may or may not be recorded, such as the death of a key personnel is not recorded in the books of accounts. So, the first step of accounting is to identify what we will record in the books of accounts. Purchase of goods, payment of rents, insurance, etc. All these are transactions which can be expressed in the terms of money and are therefore recorded in the books of accounts. Now that we have identified what is going to be recorded, we have to decide at what amount that transaction will have to be recorded. Say if we have paid a rent of 500 rupees, we are going to record that transaction at rupees 500. The next step is recording. All the transactions are recorded in a chronological order, that is date-wise. Say on 1st March you paid rent, so that transaction will be recorded in the books on 1st March. On 5th March you purchased goods, that transaction will be recorded on 5th March. This is done in the form of a journal, which we will study in detail in our upcoming videos. Now once we have recorded, now suppose the rent is paid every month on the 1st of every month. So at the beginning of the month, for all the 12 months in an accounting year, you are going to incur the expense rents. So on the 1st of April, 1st May, 1st June till 1st of March, you will pay rent of 500 rupees and record it in a journal. For the accounting period, all these 12 installments are combined together in the form of a ledger. That is, that ledger will show how much total rent you have paid at what all dates during that accounting period. That is called a ledger. that is the grouping of transaction of one nature here trends in a separate account. Next is summarizing. Say by way of installments, during the whole 12 months of an accounting period, you have paid 12 installments of rents, 12 installments of insurance, you have made multiple purchases, multiple sales, etc. So, at the end of the year, a trial balance is made where all the expenses, all the incomes, all the assets, and all the liabilities, the total figure of each of the components are shown in a summarized form. That is called the trial balance. If you look at the trial balance at a one glance, you can come to know how much total rent you have incurred, how much total insurance you've paid, how much stock you have in hand, and so on. And last is the communication, that is, providing information to the users of the financial statements. That is done in the form of a balance sheet and a PL. So, the various functions of accounting we've discussed so far are: first, we'll have to identify, that is, determine what transactions have to be recorded in the books of accounts. Next, we have to measure at what amount we will record that transaction. Next, the transaction is recorded in the books in the form of a journal. After that, all the transactions of one nature are grouped in one place known as a ledger, that is classification. At the end of the counting period, all the transactions are summarized and presented in a compact form in the form of a trial balance. And last, the financial information is presented to the users in the form of audit reports, balance sheet, PL, etc. So, the accounting provides a lot of functions and fulfills a lot of objectives. But like everything has its own limitation, so does accounting. Few of the limitations are: while you can record the salary that is paid to a worker, you cannot record the experience or the skills of the personnel. If a worker is more experienced, automatically the quality of judgment made by him will be better than a person who has no experience. Thus, intangible factors such as skills, experience, etc., play a very important role in the success of any business. But you cannot record them in the balance sheet because these are qualities and cannot be expressed in quantitative or money terms. Next, in accounts, all the figures are recorded at the amount at which the transaction is done, and all the provisions, etc., will be made at the current value only. Money factors such as inflation is not considered, so at times the values may not reflect the true figure. Next, there's a concept called provision for doubtful debt. That is, say you have a debtor who owes you money in the upcoming 3 months, but you know that the debtor will not pay you the money. So we make a provision for that amount. Now, for this is a judgment call. The debtor may or may not pay. You have to decide it basis the given data. Maybe you know the debtor personally and you know that he is going to get insolvent. He does not have enough money to pay you. So you're making a provision for it. But it might happen that he actually pays you after 3 months. So that is a judgment call. So because of this judgment, manipulation can be done, and the account, the result, the profit or the loss may not reflect the correct figure. We will study about these in more detail as you progress with the subject. Next, as you continue with the subject, you'll see that there are various accounting policies in place, that is, methods to calculate certain items. Let's say inventory, the stock we have in hand. The accounting policies or the principals have defined 3 to 4 methods by which the stock can be measured. Now, under each of these methods, the closing stock valuation will come a little different. So, by changing the policy followed, we can change the profit or loss for that accounting period. So, there is a scope of manipulation in accounting. In accounting, when we were discussing the functions, the third function we discussed was recording the transaction in the form of journal. That is actually bookkeeping, whereas accounting encompasses the entire process of recording, summarizing, classification, presentation. Bookkeeping is only a small portion of accounting where you only record the transactions in the form of journal. In the previous times, when accounting field was not so developed, only bookkeeping used to be done. But with the growing needs of the users for financial information, the scope of bookkeeping was widened, and that was how the field of accounting was developed. So let us see at a few differences between bookkeeping and accounting. So bookkeeping is concerned with only recording of the transactions, whereas accounting is concerned with summarizing and presenting the transactions in a systematic manner. Now, bookkeeping is the basis of accounting. The first stage in accounting is to record the transactions. All further steps, all the data, all the information that is prepared, the reports that are prepared like balance sheet PL are on the basis of that recorded information, whereas accounting is considered as a business of language. The financial statements do not form part of the bookkeeping process because it is only concerned with recording, whereas the financial statements are prepared in the process of accounting on the basis of bookkeeping records. Now, since bookkeeping is only concerned with recording the transactions, the financial positions of the company cannot be ascertained on on the basis of the bookkeeping record. But in accounting, we also prepare trial balance, balance sheet, PL, and such other reports, basis which the financial positions can be determined. Now, since financial position cannot be determined in the bookkeeping report, therefore, managerial decisions cannot be taken with the help of these records, whereas the accounting records help the management in making decisions with respect to the business. Next, with the growth of accounting field, there has emerged various subfields of accounting. The top three of them is financial accounting, cost accounting, and managerial accounting. Let us look at each of these in detail. What is financial accounting? So far, whatever we have discussed in accounting is actually a part of financial accounting. That is identifying the transactions to be recorded, recording those transactions, summarizing, classification, presentation to the users. Financial accounting is historical in nature because, as we discussed, you have already paid rent that you record in your books. You have purchased stock that you record in the books. So the values are historical events that has happened. It helps primarily in determining the profit and loss of the business and the financial position as on a given date. Next, we have cost accounting. Now, if you are in a manufacturing company, then to produce a finished product, you will use a lot of raw materials. You're going to incur wages, manufacturing expenses, etc. So, cost accounting is primarily aimed at ascertaining how much cost has been incurred for production of the final product. This whole process is done so that you can identify at which stage of production is huge cost being incurred so that you can minimize that cost. You can put in place efficient methods so as to reduce the cost at the production level itself. We will study this. This subject is actually done in detail as part of your professional courses or your higher studies. Next is the management accounting. So, in the financial accounting, the net results and financial position of the company is communicated to the management. Now, say the management knows that you made a profit of 10,000 rupees in a year, you have a closing stock of 50,000, you have a liability of 30,000. But the management will have to make a decision based on these figures. So, management accounting is that section of accounting which is concerned with internal reporting to the managers of a business unit. Basis those figures that we have obtained in financial accounting and cost accounting, a lot of analysis is done, such as ratio analysis. Say the manager wants to know that what is the increase in profit in the current year as compared to the last year. So for that, we'll prepare a comparative statement. Say last year the profit was 10,000 and this year it is 15,000, then we can say that there is a 50% increase in the profits. So this is a comparative statement. Suppose a management wants to know how much of the total sale amount, how much do the material costs account for in the total sale. So if we know that we have spent 2,000 on material and sale is 10,000 rupees, then we can say that 20% of the sales is material cost. So ratio analysis, comparative statements, all these help the management to make conscious decisions that forms part of the management accounting. With this, we come to an end to this lesson. I hope these concepts were clear to you. In case you have a doubt, you can post them in the comments section. If you like the video, do share and subscribe. You can also reach me on my Instagram and Facebook page. Thank you.